Okay, hello. So leave it to an investment banker to bring the quality of presentations down significantly. I want to conduct a survey pre and post. If you believe that this presentation is going to make you want to electrocute yourself, raise your hand. Really? Okay. Um, so I'll get back to you later. These presentations have really been phenomenal, and I'm going to do something a little bit different, which I hope I don't regret, which is I'm going to try and do an update on the capital markets in EdTech, mostly in the U.S., but around the world. And in order to do that, I need to go through data. And so, we saw a lot of sleek presentations. This isn't going to be that sleek, and I hope that it doesn't put you to sleep or bore you. But my goal is just to provide some context for the second part of this program, which is really focused on investing in education and EdTech. So just a quick note about myself and my firm. I've been the founder and managing partner of Eastwind Advisors. We're an investment banking boutique based in New York. We work around the world. We've worked on a lot of important M&A transactions and financing transactions over the years. But we're also partners with Matach and Mindset and Ronnie Kenneth in an investment vehicle called Mindset Capital. And I hope at some point that we could talk a little bit more about that. So let's dive in. First, some of you might not know that there's actually a public market that's been interested in the education and EdTech sector for a long time. And when we examine broad trends in EdTech, we tend to look at baskets to see how the different segments are performing. So what you see here is we broke up the publicly traded companies into three buckets. One's EdTech and education services, one's higher ed, and one's workforce development. And as everybody knows, the stock market generally has been on a tear in recent years. And I think what this chart will show you is that higher ed and EdTech and education services, when you take out a couple companies that have self-inflicted wounds, I'll talk about that in a second, they're holding their own against the S&P 500, and I think that's a good, the public markets are a good barometer for interest in various sectors, and I think with the exception of workforce, which I think is just not having a great moment right now, these stocks in the public markets are performing pretty well. Just to right-click on what's going on in those baskets a bit and focus a little bit on some of the companies that are publicly traded. I think have heard reference to Duolingo, which has really been a rock star in the public markets. Duolingo is the language learning app, and it's outperformed the broad market index up over 100% since 2021, and then in the middle, you see two companies, PowerSchool and Instructure. Has anybody heard of PowerSchool or Instructure? Okay, that's good. So these are companies that started as startups years ago and operate information and content management systems, really platforms in K-12 and higher ed and the workforce. And they performed really well in the public markets, but their boards and shareholders didn't feel like they were being rewarded. So they were ended up taken private by private equity funds. And you see in these boxes, this isn't going to be meaningful to everybody, but at pretty attractive multiples. So they felt like they weren't properly rewarded, yet they were bought out by private equity funds at revenue multiples of 7 times, which is pretty attractive for companies that are very mature, not startups that are growing at exponential rates. And then two companies at the bottom, and you heard some reference to Chegg earlier, and I think these are companies that because they're publicly traded and a lot is written about them, can give the sector a bad image, but I would assert these are two instances of companies that just inflicted the wounds upon themselves. In the case of Chegg, which is a company that provides mostly study tools to higher ed students, and you heard reference to this, were essentially accused of vulnerable to disruption from AI, and they became the poster child for the disruptive force of AI companies. But other people feel like it was just a bad earnings call, a bad performance on an earnings call where they just weren't prepared to speak about their AI strategy. But in fact, they do have a very robust and serious AI strategy. But when the public markets go against you, it's hard to recover. And then 2U, which is a company that enables higher ed institutions to bring their programs online, and was also very, very successful, had raised a lot of money, went public, made their investors a lot of money over the years, but ended up going on an acquisition path, which resulted in them taking on too much leverage. And when the market turned a couple years ago, they just started experiencing significant problems and ended up having to declare bankruptcy. So two cases, fairly isolated, which I think has generated some negative perceptions on the market. So just quickly in the private markets, on the left-hand side of the screen, you'll see the trends in M&A, and I think the point here is that we're now in 2024 year-to-date starting to rebound from a couple of the prior years that were fairly lackluster, and essentially back to where we were before the boom that we experienced during COVID. On the financing side, which is on the right-hand side, you'll see market definitely trending down since the highs of 2021, and I'd say honestly, still many headwinds for financing, but great companies are getting financed, and they're able to get financed on very attractive terms as well. It's just a much more selective market. But when you look at the numbers, we're talking of about billions of dollars that are being invested in this sector. And when I hear comments about there's really no money, no financing available for EdTech companies, I just feel like that's a misperception. And particularly in Israel, where I hear that comment a lot, I think it's important to look outside of Israel to what's going on in the rest of the world to understand the demand for high quality companies that are servicing this market. So two specific examples. These are two companies that attracted capital in October, so just a couple of weeks ago. Eruditus, which is an executive education platform company that works with universities to provide exec ed. And you'll see there, they recently raised $150 million at a $3 billion valuation, which is a great accomplishment. It looks modest only when you compare it to the amount that they were able to raise in 2021 at a similar, even higher valuation. But again, 2021 was a bit of an anomaly. It was a very frothy market, so it's not easy to make that comparison. And then on the right, SchoolLinks, which is a K-12 company that focuses on college and career readiness. And they were able to raise $80 million in a Series B just a couple years after they raised a Series A. And they experienced a 10x increase in their valuation in just several years. So what's behind all this? This is a list, not going to spend a lot of time on it, but this is a list of some of the top VCs and private equity funds that focus on education, either through an education-centric fund, so all they do really is education, defined pretty broadly, or generalist funds that have allocated capital to education. And what you see here is a lot of assets under management and a lot of dry powder that's available for companies that are seeking financing. And I just want to look at two particular cases, two funds, to just see the evolution of this AUM, or assets under management, that we're talking about. So one is Reach. That was listed in the prior slide as the most active company. And you'll see in 2015, they raised a $53 million fund. In 2023, a little over a year ago, they raised a $215 million fund. That's an early stage VC investor. Here's Renovis, which is a different part of the continuum of investors. So, different asset class, more like lower middle market, investing in companies that have several $1 million of cash flow and up. And in 2011, they raised $100 million. And last month, they raised almost $900 million. So I think the point I'm trying to make is if EdTech and education and the knowledge industries, which are all relevant to this conversation, if they weren't a good investment, there's no way that limited partners would be providing increasing amount of capitals to these funds. And then, of course, the system is further supported by what we call impact investors, who are making a very large play in this sector in a variety of different ways, more often than not hypothesis-driven, and really looking to invest in companies that can focus on the mission that's important to them. But for the most part, and I'm fortunate to have Mark here to address some of this, for the most part, doing it in a way where they're not conceding returns on capital. They feel like there's a really strong alignment between companies that generate outcomes and also deliver market returns on their capital. And we're just seeing, each quarter more and more providers of capital getting into this area as well. So I think it's important to understand that there's a close connection between the financing markets and the exit markets. If there weren't companies that were interested in acquiring businesses and providing liquidity for their early investors, then it would be hard to raise that financing. And over the years, we've seen a proliferation of companies, both strategics and then also funds, financial sponsors around the world who are interested in acquiring companies. This slide gives you a good sense. In all the markets around the world, there are larger companies and funds that are very interested in acquiring companies that meet their threshold, and in so doing provide returns for investors who are then able to recycle their capital back into new investments. So that part of the ecosystem is critical for all of this to function. I want to drill down on this a little bit in a case study just to prove this point. I've been covering this sector for over 20 years, and one of the first meetings that I had was with an institutional investor, and who was very active and successful in the sector in the early years. And as we were going through his investment strategy, I asked him, "What about K-12?" And he literally told me, "We would not touch K-12 with a 10-foot pole." I think that's sort of an American phrase. Hopefully, it translates well here. Anyway, he wasn't open to having any meetings with K-12 companies. So cut to today. This slide will show you a wave of consolidation that's occurred in the K-12 market. So on the left of the slide, you see a number of logos, and those are all the financial sponsors who have backed platforms in the space. You'll see at the upper left, A Street, and Mark will address that, but they're in the mix there. And then on the right of that, you see the platforms that they've invested in. And then to the right of that, you see all the smaller companies that they've gobbled up in the last couple of years. And so, when you see a slide like this, you need to understand that at the beginning of all these companies were early stage investors who provided capital to help these companies grow, and then at some point were able to exit, and then some of those companies were acquired and then exited again. And this is a real virtuous ecosystem, which I think fuels a lot of the interest in the sector. And this is, I note, the corner of the EdTech sandbox. that focuses on curriculum, which you wouldn't have thought 10, 20 years ago would have attracted so much capital. In other corners of the sandbox, like information services, systems, and software, we've seen a similar wave of consolidation. So we're only talking about K-12 here. Similar things are going on in workforce and higher ed. So when we were here 2 years ago, we showed this slide, and it focused on some of the trends that we had in 2015 and what's changed in 2022. So I thought I would show this and then cut to 2024. I'm sure it will surprise you to hear that the main event is AI. So everybody's talking about AI. Rather than add my opinion to the mix of opinions on AI, and there's no shortage of that, what I thought I would do is commend to you a report that was published last year, so it's a little stale, by Reach Capital. Reach Capital is the early stage investor that I mentioned before, and because of their position in the market, they last year reviewed 280 business plans for potential investments, and then they stepped back and they decided to create a taxonomy of the companies that they saw. And I thought this was interesting to just develop a sense for, essentially it's a heat map where most of the development has been and where the funding has gone. So what you see here is most of the funding has gone to companies that have startups in personalized learning and support and career and skill development. And then within those areas, study tools, teacher assistants, and co-pilots in language learning are the subcategories that have attracted the most startups. So I'm sure entrepreneurs and investors will draw different conclusions from this data, but I thought it was interesting to just understand where all the action has been in AI to date. I think it's important for entrepreneurs to really think, as they're taking their solutions to market, to think whether they're able to create something that on a standalone basis can really scale and disrupt the incumbents. In order to really make some informed decisions here, you really need to know what the incumbents in your market are doing and whether they're asleep at the wheel or innovating, and whether or not your solution is one that is differentiated enough so that it could ultimately succeed on a standalone basis, or whether it's better to fold into, to create something that is differentiated and valued by a larger incumbent, and then can be acquired and then brought to market much more quickly. There is an example that we worked on last year, which is a company called Soapbox Labs based in Dublin that has a speech recognition technology that was trained on children, and they had the choice of going it alone or being acquired at a fairly early stage, and decided to be acquired by a company, Curriculum Associates, that reaches 12 million students, and overnight, essentially, by being embedded in that company's products, they're able to penetrate the market in a way that it would be very difficult for them to do on their own. So finally, why are we here? Like, how is all of this relevant in Israel? And I would simply say we've developed a hypothesis years ago that obviously Israel is about as sophisticated a technology ecosystem as we see in the world, and has been successful in a number of categories like cybersecurity, agri-tech, food tech, automated driving, etc. Our hypothesis is that Israel has, the entrepreneurs in Israel, technologists in Israel, have the attributes that could enable it to become a global hub for education. And so that's our interest in working with Mindset and CET and Ronnie Kenneth to launch a fund that's focused on this opportunity. We had this hypothesis long before October 7th. Post October 7th, I think we feel even more committed to it and know that it's right. And we think everything that's happened in the last year proves that Israel is able to approach this type of market with a sustainable competitive advantage. And I would say we think that Israel can succeed And I would further say I think Israel must succeed in this area to save the world from itself. So with that, I will end these remarks, and we'll launch into the next part of our program.